Thanks, Owen, and for organising such a great event, and also donating, any profits to such a great cause as well. I don't think too many people would have gone out of their way to do something, so fantastic. So yeah, big, great effort from you guys for organising the event. Great. Well, yeah, first of all, thanks for having me along. So for those who I haven't met before, which is most of you, my name's Brycki. I'm the founder and CEO of a business called Stockspot, which I founded about 6 years ago now. Before that, I was a fund manager at UBS and at a hedge fund, and have traded shares for a fair long time before that. Now, this is a business I started because I wanted to help Australians invest their money smarter, and build essentially an online platform to help people invest into low-cost, sensible, diversified portfolios. So it's a business I've been running for 6 years. We've got a pretty small team here still in Sydney of 12 people. But with that small team, we manage the money of thousands of Australians and now hundreds of millions of dollars. So we've built a decent sized business, with our philosophy, which I wanted to share with you tonight. But tonight I actually wanted to talk about something a little bit different to shake things up. I wanted to talk about tennis, and specifically what you guys can all learn about the game of tennis that can help your investing. And to do that, I first need to take you all back to the year 1975. Now, I can see some of you in the audience who were probably around in 1975, a lot of you who probably weren't. So this question, in the spirit of Owen's questions before, may favour some of you, but can anyone tell me who won the Australian Open in 1975? And there's probably a double XL shirt in here for you. Any guesses? We got one. It was John Newcombe won, an Australian. And who won the Women's Australian Open in 1975? Yvonne Goolagong. Fantastic. So we've got both of them. So 2 Aussies won the Australian Open in 1975. And this was an important year because that year, on the other side of the world in the US, a very important article came out. And it was called, if I can take you to the next slide, The Loser's Game. And this article was written by a fellow called Charlie Ellis. Probably a lot of you may not have heard of him before. I'll tell you a little bit more about him later. But what you need to know is that in this article, Charlie explained that professional tennis was a winner's game. And what he meant by a winner's game was it was a game that was won by people that made lots of winners. In fact, 80% of the points won in professional tennis are winning shots. So in order to win in professional tennis, you need to outsmart and outskill your opponent. You need to make lots of winners. And he differentiated this from amateur tennis, which he called a loser's game. And he didn't mean that losers play amateur tennis. What he meant was that in order to win amateur tennis, it had nothing to do with how many winners you made. In fact, 80% of the points won in amateur tennis were from the opponent's unforced error. And so there's a big difference between playing professional tennis and amateur tennis. And ultimately, this insight, had a huge impact. He ended up writing a book about 20 years later called Winning the Loser's Game, which is what I've sort of titled my talk tonight. And this concept inspired the founding of a business called Vanguard a couple of years later, which a lot of you will know is the second biggest asset manager in the world now, which Charlie Ellis himself became a director of. And then he went on to teach at Yale and Wharton Finance. So why do I talk to you about tennis? Well, this insight that there is such thing as a winner's game and a loser's game is something I wish I learnt when I started investing many years ago. So this is from the Sydney Morning Herald. I won't tell you which year because that will date me, but it was a fair while ago. And this was me when I was, I think, 11 or 12 years old, and I just won the ASX school share market competition. Now, most of the advice that amateur investors get, including me at this point in my life, is based on the false premise that investing is a winner's game. And by that I mean investing is an area in your life where if you train hard and you work really hard and you're picking winners, that you'll be able to beat your opponents. And this is something I believe too many people who get into the investing game, whether they're investors that are professionals or amateurs, believe for way too long, including myself. It was something that I held a lot of hope on for a long time. what I realized working, well, first of all, as an amateur investor, but then later as a professional investor, and what Charlie Ellis realized, and others like Jack Bogle, was that investing, whether you're a professional or an amateur, is not a winner's game. Investing is always a loser's game. And it has been this case at least since the 1960s or 1970s. And it's undeniable. And there is all sorts of research I can point you to show you this. One of the best ones, which you can look up, was done around 2010 by the Pensions Institute in the US, which looked at all of the fund managers in the US over decades and found that less than 1% of fund managers were able to beat the market after their costs and taxes were accounted for over the long run. And now I'm not talking about the amateurs playing the stock market here, I'm talking about the professionals. And when 99% of the professionals aren't able to beat the market, you know you're playing a loser's game. And so in my view, and the view of Charlie Ellis, investing, like amateur tennis, is a loser's game where you will do best if you don't try and win, but try and avoid mistakes. And so tonight I wanted to share with you what I think are the three most common unforced errors when it comes to your investing, what they are, how you can avoid them, and also the sort of results you can expect if you do avoid them, because I think that will probably surprise a lot of you. So first of all, unforced error number one, and I know this is going to be a controversial one because I've watched all of the other talks tonight. Do not pick stocks and do not pay someone else to pick stocks. This is unforced error number one when it comes to investing. And let me explain why. So first of all, one of the more simple reasons is competition. Investing in the 1950s and 60s was a very different game. There were very few smart professionals doing it, and so very little competition. And those smart professionals who were doing it, or even amateurs like a lot of the people in the room who are learning, were able to outsmart and outplay all of the other players in the game. Because when it comes to investing, in order to beat the market, you have to remember that when you're buying a share, someone else is selling that share. And you're betting that your knowledge and your understanding of that business and your understanding of that investment is better than the person that you're buying it from. And in the 1950s and 60s, it was possible. The problem nowadays is that 95% of all trades that are happening on the share market in Australia and in the US and other markets are happening between smart professionals. So it's no longer about whether you have more skill than the other players, because all of the other players are bloody skillful too. And we've met a lot of these very skillful people here tonight. And the problem is not that they're not skillful enough, it's that there are too many skillful players out there. Investing as an industry is just so attractive because, as we've also heard tonight, you can build a lot of wealth as a fund manager, that it's attracted the smartest, brightest people in the world. And this has happened over decades and decades and decades. And this is ultimately what's led to investing becoming a loser's game, is that it's known in other industries as the paradox of skill. When a game becomes too skillful, it's no longer about the absolute skill of the players, it's about the relative skill of the players. And for anyone that's played poker, you will have seen this. If you're at a table where there are unskilled players, typically what happens is the poker players slowly take the money off the people that have never played poker before, but then you're left with a table of only good poker players, and then it becomes a lot harder. And that's what the stock market is like these days. And so competition is your number one reason why you shouldn't be buying stocks individually. And that's because the person you're buying it off is probably as smart, if not smarter, than you. And you're trying to bet that you're smarter than them, and the reality is you're not. The second reason, which I think is an even more compelling reason, is risk. And this is what this chart is trying to sort of show. So it may surprise you that actually most shares don't do well. And I think someone else showed tonight that there's something like 2,000 shares on the Australian share market. I think that's about right. Now, statistically, if you look over the last 100 years, about 60 to 70% of shares do worse than the index itself. And by that, I'm talking about the ASX 200, like Doug mentioned earlier. 60 to 70%. It's not 50-50. It's most shares do worse than the index. What's more scary than that is that 43% of shares actually have negative performance over their entire time listed on the stock market. Not just bad performance, negative performance, as in you would have been better off leaving your money in the bank. And these shares are all represented on the left-hand side of this chart. This chart shows the lifetime returns of every share listed on the US share market of all time. Now, how can this be the case? Well, it can be the case because, as you can see up on this very right-hand side here, these are shares that have made over 2,500%, and these are the shares that drive the entire share market return. In fact, a couple of studies have shown that it's between 4 to 6% of all shares that drive all of the wealth in the share market, and somewhere between, over 90% of shares actually do nothing. And if you're invested in that 90%, you might as well leave your money in government bonds or in the bank because it's going nowhere. Most people don't appreciate this, and they don't understand how difficult it is also to find those shares. And we've seen some people tonight that have their own methodologies on how to do that. The reality is a lot of people have their methodologies, but it's still very difficult. It's very easy to find them in hindsight, and there's a lot of narrative bias when it comes to people's belief of being able to find these in advance, but it's very difficult. This is why 99% of fund managers don't beat the market, is because it's hard to find those shares. And it's not like once you find those shares, you're done. These shares are constantly changing. So in the 1990s in the US, it was companies like Walmart and Dell. Now those companies aren't the ones driving the share market returns, it's the Apples and the Facebooks. And so not only do you have to find this 4 to 6% once, you need to be constantly moving in your money into this a few percent of stocks. So why is this a reason not to pick shares? Well, it's difficult to find those shares. The only way you can guarantee that you have exposure to those tiny amount of shares driving the market return is by owning the entire market. And a lot of people that say that index investing or investing in the entire market is crazy because you own a lot of garbage, don't tell you that the problem with not owning the whole index is that you miss out on the companies that are driving the returns, and it's hard to pick them. And so the reason you want to own the index is it's the only way to guarantee that you're going to own those shares that are driving all of the share market return. And this is the reason why for our clients, we only recommend investing in low-cost index funds or ETFs listed on the stock market that own the whole market. Because we realize and we believe it's very difficult to consistently pick those shares, and the evidence supports that as well. So that's unforced error number one. So unforced error number two is overtrading. So a lot of people think when you start investing that the more you do, the better your return. So if you're more active and you're making more decisions, you're going to get a better result. And this couldn't be further from the truth. In fact, investing is one of the few areas in your life where doing less will actually almost always give you better results. Almost always when you're deciding to make a trade, that decision is a bad decision. And it's very difficult to emotionally stop yourself from making that decision, but not making decisions is the best decision you can make. Now, this chart shows over many decades the performance of the index in blue across, and for those who can't see, shares is the category on the left and bonds is the category on the right. The blue bar is the index return, and then the peach bar is the return of the average investor in those markets. And what you can see is people that are making constant decisions do worse than the market. And there's a few reasons for this. One is the costs of transactions, crossing spreads, brokerage, other costs. The other one that I think a lot of people either don't appreciate or they forget about is tax. Every time you realize gains, you got to pay the tax man, and that's money that you can't have invested for you earning more compound growth. And so one of the main reasons why you don't want to trade often is you do not want to be realizing lots of tax when you invest. So unforced error number two is trading often. This is something you want to absolutely avoid when you're investing. And decades of evidence have shown that it is better to not be trading often. One of my favorite stories is Schwab, one of the biggest brokers in the US. They looked at all of the retail brokerage accounts they had, which is much bigger than CommSec has here, tens and tens of thousands, and they found that the best performing accounts were the accounts that forgot their passwords and did nothing. And this is the case everywhere else, I'm assuming. The people that do nothing are the people that do the best. And so fighting the temptation to make lots of decisions is going to put you in a much better position, and it's an unforced error that everyone else is making, and by avoiding it, you'll be better off. The last one I wanted to talk about tonight was predictions. Now, our industry is unfortunately, well known for pundits and forecasters making predictions. The problem with predictions is that not many of them are correct. And yet people put a lot of trust and weight in these predictions. The way I like to look at predictions in this industry, having worked in it for a while, is I look at the person making the prediction. And I think if this person is confident and has a track record and ultimately is one of this very small number of people who can actually beat the market, why are they telling me this prediction and not using it to make themselves a lot of money? Or why haven't they already made themselves enough money to be on the Cayman Islands? And this is the reality of the industry, is there's a lot of people out there who are making predictions who lead to people making decisions with their portfolios that they shouldn't be making. So making predictions or believing predictions is one of the most dangerous things you can do when you're investing. A good sort of anecdote is that more money has been lost predicting the next crash than has actually been made or lost in any market crash or in all market crashes altogether. And there was a wonderful statistic that came out from, I think, JP Morgan last week that showed all of these famous market pundits that have predicted the next crash since the financial crisis. I think there are 20 of them. And if you would listen to any of them, you'd be down somewhere between 40 and 70% by now. So listening to predictions, regardless of how articulate, smart, or well thought out these predictions are, is going to harm your returns. And that's why we advise clients to not listen to any predictions, to turn off the news, to not read the paper. And rather than predict, you should be trying to prepare. And what do I mean by that? Well, predicting is trying to guess the future. Preparing is accepting that the future is unknown and making sure that your portfolio is able to weather different possible futures. And the only proven way to do that over time is not timing the market, but having a broad range of different assets that move in different directions when markets go up and down. The asset that is sort of best known for moving in the opposite direction to shares is bonds. This is a chart that shows the last 7 times the Australian share market has had a negative year, and in each one of those years, bonds have risen. And so something that we advise all of our clients is to have an allocation in bonds in their portfolio, not because we think bonds are going to go up or are a great asset class, but because bonds give you the comfort of having a cushion in your portfolio when markets go down. And we don't know when markets are going to go down. Nobody knows when markets are going to go down. We know from history that they go down about 30% of years. And so when you invest, you need to accept that markets do go down. They may go down, and invest with an appropriate time horizon, first of all, but also have other assets in your portfolio that aren't going to make you wear so much pain when the market falls. Because from a behavioral perspective, we know that people are more likely to make bad decisions and sell out at the bottom if they're 100% in shares and, for instance, in the financial crisis, lose 40%, versus in a diversified portfolio that includes other assets like bonds, and we recommend gold as well. And by diversifying, you'll still lose money, but you'll lose an amount that will still keep you confidently invested or is more likely to do so. So with that, I think the last note I wanted to leave you with tonight is that like amateur tennis, investing is a loser's game. And the earlier you can realize this, I believe the more successful you will be as an investor, because you can stop focusing on hitting the winners and start focusing on reducing your unforced errors. And those unforced errors are, and the way you can solve them are by diversifying your portfolio across all of the market, by keeping your costs low and not trading at all if you can avoid it, and by not listening to predictions and simply sticking to your plan. And you could probably say, you're just saying this. Anyone can sort of say this. Well, we've been now around for about 6 years, and we recently did an analysis of our portfolios. Now, our portfolios are very simple, low-cost ETF portfolios. We don't purport to be able to predict the market, to know which asset class or which share is going to go well. But what we did was download the data of all investment funds with similar asset allocations to our funds from Morningstar. So this is a graph of all funds in Australia with between 60 and 80% growth assets, and shows their 3-year performance across one axis and 5-year performance across the other axis. And what you can see is that our 2 portfolios, the green one and the yellow one, are up on the top right corner. They've had in the top 1% of performance across 3 and 5 years. despite the fact that we're not trying to hit winners. All we're trying to do is avoid unforced errors. And so, that's the secret to success when investing that I wanted to share with you guys today. Something that I've learned over several decades of investing now, something that's counterintuitive, something that the financial industry ultimately, I think, doesn't want people to know because it doesn't generate brokerage, subscriptions, fees, but ultimately is better for consumers. And the growth of index investing around the world is showing that it's working, and I believe will continue to work for many decades to come.